Please remember that this matter should be viewed as a solicitation to trade. Trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Optimus Futures LLC is not affiliated with, nor does it endorse any trading system, methodologies, newsletter, or similar service. We urge you to conduct your own due diligence.
Now, here's your host, founder and CEO of Optimus Futures, Matt Zimberg.
Hi guys, this is Matt Zimberg from Optimus Futures. Welcome to our podcast. And today I'm going to talk about order execution. I think it's very important. I know that we don't have a chance to interact with one another over a podcast, but I would encourage you to go to our page, community.optimusfutures.com, and ask me any futures or forex related questions over there. Again, it's community.optimusfutures.com. It's where we can give you more details, attach charts, and just answer any question you might have about futures trading. Today's topic, as I mentioned, is order execution and the order types. And I know some of you are experienced in it, and there's nothing here in terms of order execution and the types that is going to be new to you. But those of you who are beginners and haven't traded for so long and want to kind of understand what orders are out there and how to use them effectively, we're going to review it today. And to be honest with you, even the experienced one can always take a refresher course. So I'm going to focus on, I can't focus on all the orders today, and I don't want to. I just want to focus on a few, because there's orders like market at the open or market on close and fill or kill. I think that they are very, very specific. And basically, I think that majority of people don't use them. Majority of the people just use limit orders, stop orders, at the market orders. And those are the ones that I want to expand upon. I think it's really important to understand order execution, because it's any game that you play, and I don't want to refer to trading as a game because I know you have your money on the line, but essentially, you know, every set of games out there has a set of instructions how to use it effectively. And I look at trading as just another mental game, financial game, that you have to understand the rules. And part of the rules are the orders. So let's start with, the basic order, which is limit orders. Now, the one thing about limit orders that you have to understand is that they are visible. So limit orders are visible. They're visible on the dome. If you have a dome, you can see the limit orders. They change all the time, but essentially what you see are limit orders. You have on the left side are all the people that are willing to sell, and on the right side of the dome are all the people that are willing to buy. So those are basically the orders are out there. And so again, they're visible. Now, in order to be guaranteed a fill on a limit order, the price has to go above or below. Then it's guaranteed. Just because it hits the price, it's not guaranteed. And this is what I wanted to talk about. The order that is not guaranteed if it hits the price. Let's take crude oil, for example. Let's say you want to buy it at 60 and the market came down to 60 and now it hit 60, 60, 60 and you're not getting filled. The reason you're not getting filled is because there are people that are ahead of you. Now, if you're using technology that has basically the latency on it is rather high, then basically it's going to cause issues. So if you're trading from overseas, from Australia, Singapore, China, or even the continent of Europe into Chicago, you really have to consider the technology that you're using. It might be too slow. This is where we help people at Optimus Futures, to find the right technology. But the only way, going back to the example, the only way to get guaranteed fill is if the price goes to, let's say, $59.99. Then you're absolutely guaranteed a fill. Now, a lot of people talk about the limit orders, not only in terms of order, but I think there are two aspects of this order that we need to discuss here. One, first of all, it's an order with a discipline. So basically, once you have a methodology, as they say, you wait for the market to come to you. You basically go in and you place the order. And that's the price that you want to go in, right? That's your discipline. As opposed to just being spontaneous and just going at the market. So if I'm a method, it says there's a support level at 60 or 58.99 or the mini S&P at, I don't know, 29.75, whatever the price is, that's where the order execution comes into place, and you put a limit order, and that's your discipline. You're just waiting for the market to get there. Many times people might get frustrated by this order because it's not getting filled or just hovering around it, and they might go and just all of a sudden go and go at the market, right? But those who are disciplined and just some of them just wait for the level to get hit. I'm not here saying that every time you put a limit order in the marketplace, you should always wait for it to get filled. Under all circumstances, there could be circumstances that you might say, hey, you know what? The market kind of hit a plateau here in terms of support. I don't think it's going to go any lower, and I don't want to miss out on this move, and you cancel it. But this is not something that you should do on an ongoing basis. If you place limit orders and cancel them, you go at the market. It has something to do with your discipline, that you're just a little bit impatient. I would suggest to be patient and just wait for the prices to hit. And if they don't get hit over a long period of time, you revise your method to another limit price or orders. Market orders essentially are orders that if you go at them, you're really expecting, a big risk reward, because first of all, there's a slippage that exists when you place a market order. But you don't want to miss out on, if you think, if you're going to get it, if the market is trading at 60 on the crude and you're going to get filled all of a sudden at 60.02 and you miss out $20, but you think it's going to make a move back to 61 where you have potentially a gain of $980, then you're like, okay, I'll go at the market. So there's a room for market orders that should exist, but obviously they come with slippage. Those of you who are scalpers, who go in and out, in and out, in and out, you miss out a tick. And that's a lot of money sometimes, especially if you have a small account. So you might consider working with limit orders. You reduce your frequency of trading a little bit, but at the same time, your slippage, preserves you don't want to have that slippage that you always have going at the market. Basically, what I'm talking about as far as, just remember, every single order entry is one where limit orders can be after you get filled, where you place a limit order for a profit, and also a limit order for an entry. So any type of order can function for both ways. Now we're going to talk about stop orders right now. So you have a buy stop and you have a sell stop. And again, I want to remind everyone that stop orders essentially are market orders. So when the price gets hit, it turns into a market order. It could have huge slippage, and you're not guaranteed to get filled because of market conditions. If the market is dropping like crazy, and you just want to exit the market, you can have a huge gap. Sometimes the market can't even execute that because every stop price has a limit to it. People don't know this, but you can click on an order, it might not get filled. So just be careful out there, and I have to make that disclaimer. So that's part of your risk management. So again, you have buy stop and sell stop. People who use buy stops when they're short, obviously, because at some point you just have to kind of say, okay, I'm wrong, right? If you're short and the market keeps on going up, you must admit that at some point you're wrong. And if you're long, then the market is falling, you put a sell stop. And again, you don't want, and you want to have those orders in place every single time. As much as people complain that they say my orders get filled and then the market turns around and goes in my favor, that has nothing to do with the order. That's because you might be, placing stops in markets that have very high ranges. Maybe you shouldn't have been there from the first place. But that's basically it. You gotta have risk management in place. You can enter orders with buy stop and sell stops. Usually people who trade breakouts, if let's say you have the gold trading, let's say at 1500, and you're saying, if it's going to break 1510, it's going to go to 1550. So you place a buy stop at 1510. Although the price right now is at 1500, some people may ask, well, why would I buy it at a higher level that I can buy it at a cheaper level now? Well, professional traders don't think about pricing. They think about value, right? So it's very hard many people to distinguish between price and value, because at 1510, the market can be more valuable than 1500. So you're not actually buying a price, you're buying value. So if it breaks 1510, then the market kind of signals momentum to the upside, and then it can go further. Same thing is on the downside. Let's say the gold is trading at 1500, and you're saying to yourself, if the market is going to break 1480, then it's probably going to go lower. But if it's not going to go to that level, it might continue higher. It just might hover here for a very long time. Again, we're trading value. We're not trading price. So at 1480, there could be potential weakness that comes in. Now, all the examples that I use are hypothetical. And it's, so you can apply it to any market out there. Let's talk about stop orders for a minute. Again, this is something that I wanted to tell to all the traders out there, whether professionals or amateurs. If you use a stop order, it doesn't mean you can walk away from the screen. Because again, stop orders have a limit order attached to them. I'm not talking about stop limit orders, which I'm going to talk about in a second, but every stop order, basically the exchanges want to regulate pricing. So if the market, let's say you're trading oil and it's at 60 and the market, let's say you want to get out at 59.80. But if the market gaps down to 59, you have to watch if you're out of the market or not, because your 59.80 can turn into a limit order, meaning that it gapped, but now, and your stop hasn't been filled, because again, every stop has a certain limit price attached to it. There's a certain range. And so you always have to watch. And I always tell traders, just because you put a stop, doesn't mean you can walk away from the screen. If anything, go into your mobile system. If you can't be there, make sure you have an app running on your phone. No, I don't encourage people to trade from their phone, but for monitoring and risk management system, at least do that if you can be by the screen. Now, going back to the stop limit order, there's a specific order which is called a stop limit. You can use it again as a buy entry or a sell entry, and you can use it as risk management. But essentially, in order to avoid slippage in the market, you can attach a limit order also into it. So, for example, let's say I would say you should use stop limit orders more on entry as opposed to exits, because you don't want the price to gap through that price and you not getting out, and you just keep on losing in your position. So let's talk for a minute about stop limit order. Let's say, again, using gold as an example, you're saying, okay, if the price breaks, it's trading at 1500 in the current month. If it goes to 1510, I want to have a buy stop. But you don't know if it's going to hit 1510. You might get filled afterwards at 1515, 1520. You just don't know. So what you want to do is say, okay, I want to buy stop at 1510 with a limit at 1512. So you're willing to give 2 points, to the market, because you think after that the move can be huge. Or you can say it's 1510 stop, 1510 limit. I don't want any worse than that. But sometimes I find you can be flexible a little bit if you have a good risk and reward. So that's where the stop limits come into place. The same thing could be applied to a stop loss when you're in a position. So you're saying to the market, I want to get filled. Let's say you're long at 60, and if the market goes to 59.80, you want to get out, and then you say, but I don't want to get worse than 59.75. The problem on exit orders with stop limit orders is that if the market gaps from 59.80 to 59.60, you're not out. you're not out because you said, I don't want to get any worse than 59.75. And that's very dangerous. So I don't recommend you guys doing that. Again, you can enter with a stop limit. I don't recommend when you want to get out, just put a regular stop, whatever the slippage is, because you don't know how much damage the market can do after that to your positions. Again, you can always go to community.optimusfutures.com and we can always explain those orders and illustrate them to you. One last thing that I wanted to mention are it's called Osio orders. So Osio orders is basically, let's say you're in a position, again, since I used the gold example and crude, I would use them again. So let's say you're in gold, you're long at 1500 and you want to put a stop loss at 1490 and a target at 1520. So essentially, you want to say to the market, if it goes to the profit first, cancel the stop. And if the stop loss hits first, cancel the profit. Those orders are called Osio orders. Now, the CME so far, if you're trading in US market, so the CME group, I should say, CME, CBOT, NYMEX, COMEX, they don't take those kind of orders. There are not native orders to the exchange. I believe that Eurex does when you trade them, but not the CME. So essentially, just remember, when you put an Osio orders, there are two places that an order like an Osio can reside. It either resides on the provider or your execution provider, whether we use here Rhythmic, CQG, CTS, OEC, TT, or some softwares, it's actually residing on your computer. Meaning that if you go through an internet outage, those orders will be working out there and one might not get cancels if one gets hit. So Osio orders, again, you always have to always ask where they reside. And the other thing is that if your internet drops, you have also a mobile version that you can refer to and basically maybe exit to that, or at least monitor to that. That's basically it, guys. That's as far as order execution. I hope it was helpful to you. Think about your method, risk management above everything. And again, just a kind of a legal disclaimer about stop losses. They might not get executed at prices that you want. There could be slippage and market conditions could be as such that you just cannot exit. I would say that this happened before. It rarely happens, but so far in my experience, but it could happen. So always watch out for it. That's basically it. If you want to get in touch with us, please come to optimusfutures.com. And you can always call me. It's 1-800-771-6748. Our local number is 561-367-8686. If you have questions about opening an account, go to support@optimusfutures.com. And again, any trading related questions, software related questions, or anything of that sort, please visit our community.optimusfutures.com. I wish you a great trading week. Thank you for listening and take care of yourself. Bye.
Please remember that this matter should be viewed as a solicitation to trade. Trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Optimus Futures LLC is not affiliated with, nor does it endorse any trading system, methodologies, newsletter, or similar service. We urge you to conduct your own due diligence.